I want to quickly talk to you about accounts receivable KPIs. And it's important to understand that if you're trying to really put some efficiency into your accounts receivable processes, key performance indicators are going to be quite essential. Okay. So into this conversation, I'll be saving you tons of money. I'll be showing you a lot of tricks, a lot of hacks, a lot of tips to really make sure you're really streamlining your accounts receivable process. So here are the generalities I want to really pay attention to. The thing is that monitoring accounts receivable key performance indicators allows you to really track a lot of things. Okay, you can track your team's performance. You can track your revenue management, let's say efficiency. You can really see exactly what's really happening when it comes to your cash inflows and cash outflows. So different performance metrics can show what's working well within your business. They can also show what areas need improvement to achieve financial health. Right, that's what you need. You need to really have a clear idea what kind of processes you have to improve on to make sure you are really saving money big time, and you're also collecting cash from your customers real fast. So let's first define what accounts receivable KPIs are before I give you those KPIs you want to focus on this year. So accounts receivable KPIs are basically metrics, okay? So numbers, data, metrics that show how your business manages and collects cash from customers, of course. So different KPIs provide a detailed insights into a company's cash flow and liquidity. And the cool thing is that not every KPI will work for every company. So you do have some flexibility when it comes to choosing the KPI or KPIs that actually work for your business. So you need to consider actually your goals and business strategy and focus on a few key metrics so that you have a clear idea of what works and actually what doesn't work. Okay. And it's one of those things where you have to really go through, let's say, a period of trial and error to do some kind of iteration to see what works, what doesn't work, but most importantly, what kind of KPIs really fit within your business operation. Okay. And besides the 10 KPIs, the 10 or 9 KPIs I'll be sharing with you in today's conversation, you also have a cash collections, you have the number of revised invoices, and you have operational cost per collection. Because see, if you are collecting cash from, let's say, hundreds, if not thousands of customers, you got to really streamline the process. Otherwise, you'll be losing a lot of cash just collecting cash from your customers for products or services you have already shipped or services you have rendered. Okay, so that's really important. So let me share with you a few KPIs to really focus on. Actually, it's not 10 that I want to share with you, 9, but those 9 very sweet, very straightforward that you have to focus on this year. First, you have the ADD, the average days delinquent. So this is basically a metric related to customer payments. So basically, ADD indicates how many days it takes for a customer of yours to pay for the products or services they ordered after the due date. Okay, so let's say the due date has passed and how long it took them to actually pay you. So the average days delinquent is actually a valuable accounts receivable KPI because it can establish at what point bad debt can become a problem for your business. Okay, and this metric is really cool also because it really indicates your accounts receivable team's performance. So if your team, let's say, if your team can't recover invoices past their due date, you may need to actually look into their strategies, maybe change a few things here and there, change a few tactics here and there. Okay, and you can actually determine the average days delinquent with a simple equation. Just divide the balance of your total past due accounts by your total accounts receivable balance. And if you get a high number, you may be targeting the wrong customers, or you may have an understaffed team. And over time, tracking actually ADD can show the state of your business. You will see if it's improving, falling behind, or even static. Next, you have another metric that I love a lot. It's called ART, accounts receivable turnover ratio. Okay, and here this ratio indicates how quickly your accounts receivable department collects payment and turns them into cash. And you can calculate the accounts receivable turnover ratio by dividing actually your net credit sales by the average accounts receivable. Let me repeat that. You are dividing net credit sales by the average accounts receivable. So net credit sales are basically a sales generated through extending credit to customers, less all returns and discounts, okay? And simply put, net credit sales are basically what your company achieves after regular and early payment discounts, allowances, and returns. I want to share with you another accounts receivable KPI, and this is actually called CEI, so Collection Effectiveness Index. Okay, here you are basically going a little further because ART indicates how often accounts receivable turn over. The Collection Effectiveness Index shows how well your team collects payment, and the Collection Effectiveness Index is actually measured over 1 year. So, I mean, I've seen some companies that really measure it over 6 months, but it is actually standard practice in the industry to measure it annually. Okay, but you can do it more often if you want more precise results. So, regular checks over the CEI offer up to date insights into gaps into your processes, your accounts receivable processes. So let me give you the formula for calculating the collection effectiveness index. I'll be putting this on the screen so it's pretty clear to you. So you have beginning accounts receivable plus monthly credit sales minus ending total accounts receivable. That's actually the numerator of the fraction, and you have to divide that by all beginning receivables plus monthly credit sales minus ending current receivables, and you multiply that fraction by 100. I'm going to put this on the screen because it can be really confusing, but yeah. So the higher the CEI, the more effective your team is at collecting payments. Ideally, the number should be above 80, 85, okay? Of course, you should aim to be as close to 100 as possible. And if the number drops, check if you are targeting the right customers. If targeting is not an issue, check for your team's effectiveness. Another KPI I want to share with you is actually the DDO, so deduction days outstanding. Now, so customer deductions are amounts that the clients owe but don't pay for several reasons. I mean, the economy, or they're having a bad season, or they just are not willing to pay because maybe there are problems with the shipments or whatever. Okay, now so you have a lot of reasons. So disputes, incorrect shipping methods, packaging errors, or something else. Now these deductions represent revenue leakage or hidden profit. As such, it's important to resolve them as soon as possible. Otherwise, you'll be losing cash like crazy. Okay, so deduction days outstanding is a performance indicator. It shows how effective your AR team is at resolving deductions, and the metric provides insight into the average number of days your accounts receivable team will need to resolve an outstanding deduction. So if you want to know your DDO, you want to divide the number of open deductions by the average value within a certain period, usually a year. Okay, so a high number indicates it takes a long time for you to get paid. Then this can affect your company's profitability and cash flow. Let me talk to you now about Deduction Effectiveness Index, DEI. So this is actually, it's important to understand that deduction management and recovery are basically a large part of the job for any accounts receivable team. Unfortunately, this can be complex because no universal rules apply to every industry and company, right? But that doesn't mean that there is not a way to check your accounts receivable team's effectiveness, if they're working hard or they're just, hardly working. So the Deduction Effectiveness Index measures the effectiveness of collecting deductions. And the cool thing is that this metric also establishes whether your company is leaving profits on the table. And if it is, how much it is actually leaving on the table. So if you want to calculate it, you want to compare your total deductions found to be incorrect, and collected deductions. Do this for different categories like returns, damage, shortage, discounts, so etc. Okay. Another accounts receivable KPI I want to share with you is actually the number of invoicing disputes. So the number of invoicing disputes indicate how many invoices need revisions due to different errors, and those mistakes can happen in processing, right? Manual data entry or billing. So keeping track of this is actually vital because mistakes can be costly for any company. So identifying issues can help you come up with a strategy to resolve them and improve your effectiveness. And you want to do this as often as possible so you can really see what works and what doesn't work. One thing I want to say here is that, of course, every industry is different. Maybe your company is every company is different. Every industry is different. But the most important thing is that there are some uniform rules that apply to accounts receivable that should really fit your business no matter what. Let me talk to you about another accounts receivable KPIs I want you to really pay attention to. That's actually bad debts to sales ratio. And so this KPI indicates bad debt. That is what? The percentage of credit sales that go uncollected. And you can calculate your bad debt to a sales ratio by dividing your company's uncollected sales by annual sales. Then you should multiply that number by 100. So when I talk about credit sales, those are sales that you actually that you establish, and the customer is not paying you right away. He or she is paying you 15 days after the invoice, or 30 days, 45 days, 60 days, 90 days. It really depends. So usually you have those invoices labeled as net 15, net 60, net 30, net 45. Okay. So ideally, the bad debt to sales percentage should be below 15%. So a bad debt to sale ratio is anything above 25%. So high numbers could indicate numerous issues within your company. And these issues can be a lack of communication with your customers, or issuing incorrect invoices. Or increased numbers could show that your company is growing too fast and your current system can't support this growth. You also have the percentage of high risk accounts. So doing business with a high number of high risk customers can lead to a bad debt and other problems. But this is also part of a business strategy in certain cases. For example, you can actually choose to do business with high risk accounts when you have an excess of products or depreciating inventory you need to sell, right? And you can also do it when you want to penetrate a new market. Plus, many industries are inherently high risk, such as crypto or CBD industries. So those are things you have to really understand, that it's on a case by case basis. So as a business owner, what happens here is that you got to constantly find a balance between working with many high risk accounts and having a low tolerance for risk that can hurt your sales. That's why you really got to keep track of the percentage of high risk accounts. And first, you want to determine the factors that constitute a high risk account. Then you want to classify and the existing and new accounts according to those factors. So knowing that this percentage can help you big time, because it can help you establish what's driving the accounts receivable performance over time. Let me talk to you about another accounts receivable KPIs that I want you to really pay attention to, and this is one that really is quite essential for many industries and also for many stage businesses. It can be early stage, it can be a brand new startup, it can be an established business. So this is the staff productivity, and the staff productivity actually is important because it is not, once again, based on any industry. It has to do with a lot of internal dynamics. Okay, so when it comes to accounts receivable performance metrics, you want to make sure you never forget your staff productivity. And it's not just about your accounts receivable or staff. It can be your revenue management, staff. Anybody who is involved in your company's revenue cycle should really should be factored into this equation. This actually includes salespeople. So the more productive your accounts receivable team is, the more successful your company will be. The more productive your revenue cycle team is, the more successful your company will be. So determining that sort of productivity right off the bat is going to help you big time. So depending on your focus, there are many ways to measure your team's productivity, and every industry is different. Every company is different. Every team is different. Okay, every geography is different. In some countries, productivity is measured differently than in others. For, for example, you can base your calculations on the average time your employees spend completing a particular task, or you can calculate the average number of employees required for a specific project. So, this is actually, it really depends on a lot of things. Now, when calculating your team's productivity, remember the general rule. You want to get the most units of output for the invested units of input. And ideally, your accounts receivable team should maximize their output, which involves collecting invoices, processing invoices, resolving outstanding invoices. So this is the trifecta I want you to really pay attention to. Collecting invoices, processing invoices, and resolving outstanding invoices, like bad debt or past due invoices. So when you think about accounts receivable KPIs, let me share with you a few extras so you know exactly how to save money and actually collect more revenue for your business this year. One thing for sure, it's critical to recognize the importance of accounts receivable KPIs. Okay, keeping track of essential accounts receivable KPIs is actually vital for numerous reasons. First, tracking these metrics can help you manage your cash flow by reducing the cash tied up in AR. Second, accounts receivable KPIs allow you to maintain adequate working capital and avoid bad debt. Now, some KPIs like bad debt to sales ratio let you make wise decisions when it comes to credit terms. Should you maybe just instead of doing net 30, you might want to do net 15 or net 20. Okay, this allows you to take advantage of the benefits of your credit period fully. So, thanks to accounts receivable KPIs, you can determine the expenses related to collecting payments, collections performance, average payments, and active accounts. And the metrics provide a detailed insight into how your company operates and your team efficiency. In other words, you have a clear idea what works and what doesn't work. And you have a clear idea also about why it doesn't work in the first place, okay? What I want to say here is that your team's efficiency is going to be very critical, because with accurate data, you can pinpoint problems in the invoicing process. Data also demonstrates payment communications, collections teams, and billing problems. And you can also go through your accounts receivable KPIs to review your team's performance, and if necessary, make changes that would enhance it. Okay, so it's really a good thing. Now, if you were to ask me what's a good percentage of accounts receivable, well, you want to really be around 15 to 20%. So the average accounts receivable older than 90 days should be really around 15 to 20%. Otherwise, you are losing money big time, okay? Keep in mind that the percentage could be much higher or much lower, depending on your industry, depending on your credit policy, depending on your business history, depending on your clients too. Some clients pay fast, some clients just take their time to pay. In conclusion, to this conversation, I spoke to you about accounts receivable KPIs. I'll give you the generalities, and then the top KPIs, and finally, the extras. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.